All right, greetings. This is Eric here. So first of all, let me thank you for taking the time out of your day to view this video. And so what I've done is over the last few days, I have recorded several options trades that I put on. And in this video, I'm going to curate those trades or basically walk you through those several trades that I have put on over the last few days, with the intent that you'll actually learn something. Specifically if you're looking to get into the world of options trading. So let's go. All right, so I'm going to start the video here. All right, so let me just stop it right quick. So this trade was put on September the 28th. And as you can see here, this is a vertical call credit spread, right? So a vertical call credit spread where essentially I sold the strike price of 37.40 and I bought the strike price of 37.50. So this is called a vertical credit spread, right? Because you are simultaneously selling and also buying option contracts. In this case, I'm on the call side. And these option contracts have the same expiration date. So when I put on this vertical call credit spread, it was on the day of expiration. So I put the trade on the same day that the option contracts were due to expire. And that was September the 28th. Okay. So as I have said in previous videos, when you see a negative sign, right, on the number of contracts, that means I sold that option contract. And when you see a positive sign, it means I bought. So in this case, I have sold two call option contracts for this vertical call credit spread. So let me just start the video again. All right, and so again, the idea is for the price of the underlying. So again, I'm trading the SPX. And what I'm also showing in this video is the fact that, and let me just stop it here, is the fact that in addition to putting on a vertical call credit spread, I also, and on the same day of expiration, I also put on an additional or another vertical call credit spread that was due to expire on the next day, on September the 29th. So the first one was put on the actual day of expiration. And then the second one I put on was for the next day, September the 29th. And they are both vertical call credit spreads. And as you can see here, this one, as you can see here, this one consists of me selling the call option that has a strike price of 3,800 and buying the call option that has a strike price of 3,810. And in this case, I'm selling 4 contracts of this vertical call credit spread. And again, these are call options because they are on the call side. Right? This here is the put side. So anything over here will be puts. Anything over here are considered call options. All right, so let me start the video again. I'm going through, and so as you can see here, so my entire credit for selling those two positions, those two vertical call credit spreads, the credit that I received was $360. So at this point in the trade, and so these trades were put on September the 28th at roughly 1:45 p.m. Eastern Standard Time, right? And so right now, so during that particular time, the P&L of these two vertical call credit spreads essentially was negative, right? Because I had just opened the positions. I'm going to let the video run. So I'm just going through and just showing you the two positions that I have on. right, the two vertical call credit spreads, one due to expire on the 28th and one the 29th. Now, let me just stop the video here. So now the reason why I went on the call side, so now a vertical call credit spread is a bearish strategy, meaning that you are putting on a vertical call credit spread because you are anticipating that the price of the underlying, and the price of the underlying in this case is SPX, you are anticipating that it's going to drop in value, it's going to decrease in value. So if I look at, so I'm looking at this this chart here, this 5-minute chart, and as you can see here, this candlestick is in red. It's showing that the price of the underlying is pulling back, or it's decreasing in value. So that's the reason why I decided to go on the call side, because the call side benefits from the underlying's price decreasing in value. Let me just restart the video here. And so I'm just going through and kind of showing you, and also here's another thing to be aware of. Okay, the video is still running. Okay, I'll come back to that. Okay, so I'm just basically going through and just showing you, okay, the position is still good, right? Because the objective of a vertical call credit spread is in order for me to walk away with the entire $360 is the price of the underlying. Right, in this case, again, the underlying is SPX, the price of the underlying, which is conveyed by this circle here, and the actual price is shown here, 37.10. So this circle essentially has to stay below my short strike on the call side when this position expires on September the 29th. Now we are still on, so in this video, this screenshot here is still based on September the 28th, because I put this trade on September the 28th, but it actually expires on September the 29th. So you're looking at two positions here. All right, so let me restart the video. So I'm just going through and showing you that, look, I have two positions on. So now you can see the P&L is in green now. All right, so it was in red initially, but now it's in green. And so this here is the vertical credit spread that I put on the actual day of expiration, which is September the 28th. And as you can see here, the price is still where I need it to be in order for me to be profitable at the end of the trading session on September the 28th. And the market closes at 4 p.m. Eastern Standard Time. All right, so I just want to make sure that folks are aware of that if you are new to the stock market. So the video is running. Okay, so as you can see, so now is September the 28th. It's still September the 28th, but it's roughly 5 minutes before the market closes. So as you can see here, the price is somewhat close. It's somewhat close to my strike price of 37.40. But I know it's not gonna, I'm pretty confident that it's not going to breach the price of the SPX is not going to breach my strike price of 37.40, and right now is at 37.31 on September the 28th at approximately 3:55 p.m. All right, so let's see how this plays out. All right, so let's go back to the video, let it run. Now you can see my P&L was negative. That's only because the price is close to my strike price of 37.40. So that makes my contract more valuable. So it kind of skews the P&L. But as long as it stays below my strike price of 37.40, I walk away with, in this case, $140. All right, so we got roughly Right, so the market is about to close, so we got roughly 30 seconds before the market closes on September the 28th. Right, so that first position I sold 2 contracts, and I received $70 for each one of those contracts. I received $140. So the market is about to close in roughly 10 seconds, and so as you can see here, I'm going to get the entire $140 for selling these 2 contracts for $70 each. All right. So that first trade was $140 profit. So now, okay, let me just stop the video. All right, so we're on the second trade. Let me start the recording here. So we're on the next day, September the 29th. And as you can see here, here's the expiration date, September the 29th. And considering that I've already gotten 87% of the $220 that I took in as a credit, I'm just going to close this trade out and go ahead and take the money. So the market just opened. It's essentially 9:30 a.m. So I'm looking to close this trade out early. I'm just letting the recording run here. So now I have my closing order in. So as you can see here, I'm asking to close out the trade. So when you close out a trade, you have to buy it back. So when you sell an option contract, in order to close it out early, you have to buy it back. So I'm looking to buy it back for less than the credit in which I received for selling the option contract, or in this case, the vertical call credit spread. So I sold each contract for 55 cents. So I'm looking to close it out. I'm looking to buy it back for 5 cents, which is really $5 because every option contract controls 100 shares. So let me just restart the recording here. So now, because the market is asking for $12, well, $9 now, and I want to pay $5, I'm going to essentially go back in and recreate my closing order. So I'm going to close out this particular order, and I'm going to put in a new closing order for what the market is asking for. So as you can see here, I'm going to replace the order. I'm opening the key there, and basically I'm saying, okay, whatever the market is asking for, okay, I've just got out of the trade now. So whatever the market was asking for, that's what I essentially was willing to pay. That was a $180 profit on that particular trade. All right, so we're on the last trade here. I had to cut the video short. So as you can see here, I'm in a vertical call credit spread and also a vertical put credit spread. The market's about to close, and you know, there it is. So I made $260 on that particular trade. So there you have it. All right, so that's actually not the last trade. So today is September the 30th. I've actually extended the my recording to this day. So as you can see here, I'm in a iron condor. So I sold a vertical put credit spread. So I sold the 35.40, and I bought the 35.30 on the put side for 5 contracts. And then on the call side, right? So we're on the call side as well. So I sold the 36.85, and also I bought the 36.95. So a vertical call credit spread and also a vertical put credit spread. So those together make up an iron condor. So I've taken in $350 on this particular trade. So as you can see here, it's 2:47 p.m. Eastern Standard Time. So I've already made $220, or 63% of the $350 that I've taken in as a credit for this particular position. And so again, the price of the underlying has to stay in between. Let me just change my. Well, I'll keep the purple color. Has to stay in between my short strike of 35.40 on the put side and my short strike of 36.85 on the call side. So we have roughly a little over an hour before the market closes. And so I I strongly suspect that the price of SPX will stay in between my short strikes on the put side and also the call side. So I'll come back right before the market closes to give you guys an update and to show you where I am in the position. All right, so we're back. Got about roughly 30 minutes before the market closes. As you can see here, the position is still exactly where I need it to be. So the position is right in between the short strike of 35.40 on the put side and the short strike of 36.85 on the call side. I roughly have made $340 of the $350 that I took in. So roughly I have made 100% of that $350 thus far, but I'm going to allow the trade to expire, which will be at 4 o'clock today, roughly 30 minutes. But I wanted to discuss briefly why I decided to put on this trade. So this morning I actually put on the vertical put spread first because the market was trending down. It's already down 16% from roughly, if we look at this 3-month daily chart here. So on what day was that? On August the 16th, the market was at roughly around 43.25, and so it's been trending downwards ever since. So right now it's down roughly 16%. So as a result of it being beaten up so badly, I decided that it made sense to put on a vertical put spread first because I suspected that the market would not continue to fall as significantly as it has over the last several weeks. And so I figured that at least at around 3600 that the market should find some support. And as you can see here, it has not gone past that 3600 mark, although it did get down below that earlier today. Let's just look at that. Yeah, so it got down close to it. It got down to 3603. Yeah, earlier today. And it's actually there now. So again, I decided to go real deep on the put side, suspecting that the market would not drop that significantly, considering that it's already down 16%. So I put the vertical put spread on roughly around 9:30, 9:35, 9:40 this morning, and then let's just look at the activity here. Yes, I put that trade on at 9:54. So I sold 5 contracts, and I took in $45 for each contract that I sold for that vertical put spread. So that gave me $225. And then I put on this vertical call spread, right? Again, sold the same number of contracts, sold 5 contracts for $25 each. And so that gave me $125. And so that's the reason why you see the 350 here. So it's considered a symmetrical iron condor. And again, an iron condor is just a vertical call credit spread and also a vertical put credit spread. And they both have the same number of contracts. As you can see here, 5 on the call side and 5 on the put side. And so because every sector that makes up the S&P 500, with the exception of the real estate sector, is in red, then that means that the price or the value of SPX is going to experience a headwind, right? The value is going to be suppressed. So even if the price tries to move up, considering that pretty much all the sectors, 10 out of the 11 sectors that make up the S&P 500 are in the red, then, the thought of the price moving up, it's not even a, so I don't look at the vertical credit spread being tested by the increase in the value of the underlying, because again, there is a major headwind because these, the majority of the sectors of the S&P 500 are in the red. So hopefully that makes sense. But again, we're at roughly 3:30, so we got 30 minutes before the market closes. And so, I can pretty much close this out now if I wanted to, or I can just wait until 4 o'clock and let the position expire worthless, meaning that the both positions, the vertical call spread and also the vertical put spread, will expire out of the money. And they are out of the money because the price of SPX is above the value of both strikes on the put side, 35.40 and 35.30, and also below the value of the strike prices on the call side, 36.85 and 36.95. So here's the actual price of SPX here. So it's 36.16. All right, so we're back. So we have less than 5 minutes before the market closes. As you can see here, the market is starting to sell off, but nevertheless, it definitely will not reach or get below my strike price on the put side of 35.40. So as you can see here, I've made the $350 in its entirety. So, this trade with the last 3 trades that I showed you guys, basically a total of roughly $930, so close to $1,000 on just, a few trades. So not bad at all. Not bad at all. Yeah, so again, I want to thank you guys for taking the time to watch this video. Hopefully you learned something, and hopefully you're starting to understand and starting to see the power of being able to trade the market, whether it be, just trading stocks or trading options. I prefer options. But yeah, I always tell my my students that being able to trade is a very invaluable skill set to acquire, because once you learn how to pull money out of the market at will, you'll never be broke.